How debt can actually make you money. Here's how. Americans are up to their necks in debt. According to the Debt Organization, the total U.S. consumer debt in 2019 was $13.86 trillion, which included mortgages, credit cards, auto loans, and student loans. Consumer debt helps the economy grow, and economic growth means there will be better paying jobs, making it easier for people to pay off their loans. Faster debt will allow you to get a home, pay for your education or your child's, and own a car without having to save all that money first. However, debt, if not managed effectively, can be devastating, especially when the economy goes into recession. In a recession, jobs are lost, making it difficult to repay loans, consequently defaulting, ruining individuals' credit reports and their ability to take out further loans in the future. Even in a strong economy, most people tend to take on too much debt due to unexpected medical expenses and inadequate financial disciplines. Consequently, many individuals and families struggle to live financially from paycheck to paycheck. So it's no surprise that debt has taken on a negative connotation. There have been many books, articles, TV programs, and resources dedicated to teaching you how to get out of and stay away from debt. Before continuing, dear viewers, if you appreciate the content of this video and are satisfied with it, we invite you to consider the option of subscribing to our channel or supporting us with a donation. Your support is essential for the growth and constant improvement of our channel, and it will allow us to continue producing high-quality content for you. You can do it here below, through the appropriate buttons, subscribe, and thanks. But debt isn't all that bad if you learn to use it correctly. Debt can be a path to wealth. The key word here is financial leverage. It helps you lift a heavy object with relatively little effort. Similarly, debt can be used as leverage to multiply monetary returns. Leverage refers to the use of borrowed funds to exponentially increase returns. With leverage, you can achieve profits that would otherwise not have been possible using only your own money. However, you run a greater risk of losing your capital. Here are 5 ways you can leverage debt to make money. A margin investment allows you to aggressively buy more shares than you could afford. You can make a lot of money if things go as planned. On the other hand, when things go wrong, you risk losing everything. Here's how it works. If we say you have $10,000 in your brokerage account, you can open a margin account based on your initial investment. With a margin account, you can deposit only a maximum of 50% of the cost of a security. So if you intend to buy a security worth $20,000, the brokerage firm where you have $10,000 will lend you an extra $10,000 to complete the purchase. If the stock price increases, you can repay the loan and make some profit. On the downside, stocks could fall, and if they fall below a particular value, your brokers will make a margin call. Margin calls are requests for additional funds or securities to bring a margin account up to the minimum maintenance margin. If you can't meet the additional funds or securities required, your broker may force you to sell assets, regardless of the market price, to meet the margin call. Hedge funds are funds that are generally pooled by institutional or high net worth investors. Fund managers seek high returns with these funds using unconventional investment strategies. One of these tactics is the use of financial leverage to pursue massive gains. They engage in margin trading that leverages their brokers' money to make larger investments. They also obtain lines of credit to invest with the hope that their gains will exceed the interest. Investing with lines of credit uses the same principles as margin investing, but this time instead of borrowing from the broker, the hedge fund borrows from a third-party lender. Hedge funds are known for achieving huge returns with leverage. Some are known to leverage up to 10 times their total assets. On the downside, if a fund manager miscalculates, they can lose all of the investor's capital and cease operations. Leveraged ETFs or leveraged securities that allow investors and traders to amplify their returns by going long or short on a benchmark index or underlying commodity using futures and/or pools of borrowed money. Fund companies have brought investors to multiply returns and losses up to 300%. You can invest in specific bond indices, commodities, or sectors. For example, the ProShares Ultra S&P 500 takes the underlying S&P 500 index and boosts it in such a way as to create a one-time upward movement that will result in a threefold change in the value of the ETF. However, it doesn't always go as planned and results are not guaranteed. Leveraged ETFs reset every day, so if your strategy is to buy and hold, your position will be reduced to zero due to the way the ETF is set up, even if the market has performed extraordinarily well. So leveraged ETFs are meant for short-term trading. Investors are attracted to leveraged ETFs because of the potential for extraordinary profits during market boom periods. Experienced traders can achieve unmatched returns with leveraged ETFs. The problem with leveraged ETFs is that they also amplify losses in the same way they amplify gains. The entire investment can be wiped out as the single short sale is a bet on a stock price falling rather than rising. Investors borrow shares from their brokers' accounts and sell them at the current market rate. Their plan is to repurchase those shares at a lower price in the future and return the borrowed shares to the owner or lender. Short sellers hope to profit from the difference between the proceeds of the short sale and the cost of repurchasing the shares. This is known as short covering. For example, if you short sell 100 shares of a $20 stock, you'll end up with $2,000 in your account. If over time the price depreciates to $10 per share, you can cover your position by repurchasing the 100 shares at $10, which will cost you $1,000. With your position covered, you've made a profit of $1,000 from the transaction. It's up to the brokers to decide whether a stock can be sold short, as they find the shares to lend to the short sale trader. This is usually automated and the broker will automatically recover its shares once the short is covered. However, for short selling, losses are unlimited, meaning a short seller can lose much more than their initial investment. Compared to stock trading, Forex allows you much greater leverage. In some cases, you can leverage your account up to 100 to 1. This means that for every $100 in your account, you will be able to trade up to $10,000. The Forex market offers such high leverage because the risks involved are greater. Manageable leverage is a function of risk, so if a trade is well managed, the risk is also well managed, which is why they can offer such high leverage. Currency trading allows investors to make a transaction with borrowed funds. The borrowed funds are used to increase investors' trading position beyond what they would otherwise have as an available cash balance. They can potentially turn their small initial investment into large amounts instantly. Conversely, an investor can amplify their losses in the same way, and the greater the leverage applied to capital, the greater the risk. A trader could be wiped out in a matter of minutes. In conclusion, debt has gotten a bad reputation, and for good reasons. Too many people take on too much debt for the wrong reasons and end up struggling financially. With good debt, it will work in your favor if used effectively. Despite all the negativity surrounding debt, with the right knowledge of the power of leverage, you can grow your wealth exponentially. We would like to know about your experience regarding the topic covered today. Share it with us in the comments, and, if you have any questions, do not hesitate to ask them. We will gladly respond. Your like would be a source of satisfaction for us, and of course, do not forget to subscribe to the channel so you don't miss the upcoming publications.